Here's what's happening in the oil and gas trenches across Texas, southern New Mexico, and northern Louisiana. The Dallas Fed just dropped their Q1 2025 numbers, and here's a story brewing beneath the surface that deserves our attention. The headline reads modest growth, business activity index at 3.8, down from 6.0 last quarter, but still in positive territory. Production's ticking up with oil rising from 1.1 to 5.6 and natural gas flipping positive from negative 3.5 to 4.8. On paper, that's a win, but dig deeper and you'll find the real narrative. The Outlook Index just plunged 12 points into negative territory at negative 4.9, while uncertainty spiked to 43.1, the highest reading in recent memory. That's not just a statistical noise, it's a seismic shift in sentiment. The numbers don't lie. Costs are surging across the board. Oilfield services input costs jumped from 23.9 to 30.9. Finding and development costs for E&Ps climbed from 11.5 to 17.1. Lease operating expenses soared from 25.6 to 38.7. This isn't just inflation, it's structural squeeze that's tightening the vice on operators' margin. One executive told the Fed that steel and aluminum tariffs have already jacked material cost up by 25%. Dallas Fed economists estimate that's translating roughly to 4% higher drilling expenses across the board. The March tariffs are already biting and are expected in April. This isn't abstract policy. It's dollars and cents on the ground. When OCTG pipe, casing, and tubing costs spike, completions slow down. It's that simple. The irony isn't lost on anyone. Washington's taking energy dominance while simultaneously it's more expensive to pull hydrocarbons from the ground. Politics and economics are colliding in the patch and operators are caught in the middle. Despite the headwinds, the industry isn't abandoning the hard-learned lessons of previous cycles. Capital expenditure increases remain modest for 2025. Companies are prioritizing balance sheet strength and shareholder returns over growth at any cost. This isn't your 2014 boom-bust oil patch, but today's operators are running leaner, smarter operations with an eye on sustainable returns rather than production records. Executives are pegging WTI at $68.32 by year-end with forecasts ranging from $50 to $100. Henry Hub natural gas is projected at $3.78 per million BTU with estimates from $2 to $5.25. That spread tells you everything about the uncertainty in the market. What we're seeing isn't just quarterly fluctuation, it's an industry at the crossroads. Geopolitical tensions, trade policy shifts, and regulatory hurdles, particularly in states like California, are creating a perfect storm of uncertainty. The patch hasn't weathered storms. Well, it has weathered storms before, but this one's different. Wow. It's not just about price volatility. It's about fundamental questions of how energy policy, trade policy, and market forces align or collide. The smart money is watching three key indicators. One, how the tariff situation evolves through Q2 and its impact on completion activity. And then two, whether capital discipline holds if prices strengthen. And three, if the uncertainty index continues to climb or finally plateaus. The industry remains resilient, but the path forward isn't as clear as it was just 3 months ago. Operators who can navigate rising costs while maintaining operational excellence will separate themselves from the pack. For all the talk of energy dominance, the reality on the ground is more complex. The Dallas Fed numbers tell a story of industry adapting to new challenges while staying true to hard-won wisdom about sustainable growth. That's the view from where I stand or sit. Not just numbers on a page, but the real pulse of Americans' energy heartland. Mark Roach, FutureWise Energy.